The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organisation mentioned in this podcast.
Okay, it is Friday the 21st of March. Welcome back, Jeremy. Good to have you here.
Yeah, hi Gareth. Good to be here.
This is the first time for a number of weeks I'm able to start off by saying it seems to have been a very quiet week with almost everything we've seen pretty much in line with expectations and no real surprises. So I'm hoping that you think that's a good thing.
Yeah, I think the real headline-grabbing Trump noise from Washington has died down a bit. But I think from a high-level geopolitical point of view, Trump's phone call with Putin has left the war in Ukraine unresolved, and the ceasefire seems to have broken in the Middle East. And we've still got an oil price that's firming up a bit, partly on the back of all this. But yeah, the common theme this week has been central bankers and companies talking about trade-related uncertainty. So at the monetary policy meetings we've had in the last few days in Tokyo, New York or Washington or where it is in the US and London, central bankers are sort of balancing growth headwinds against upside inflation risks. And in all cases, there's a tendency to blame tariff uncertainty as this exogenous shock to their model-driven world where they're trying to control and balance the expectations of growth versus inflation. This has meant overall that forecasts of GDP growth in the major economies in the world are coming down, but inflation expectations remain heightened. And this is a worry because although Jay Powell used the word transitory this week, which we haven't heard for a while, the message he's essentially delivering is one of stagflation. And he's left the market with the view that actually the next move in rates will be down and maybe we'll get 2 or 3 of them later this year. And that's being deemed by the investment community to be good enough.
Yeah, and that US inflation has been transitory for quite a long time now, hasn't it? At what point does that become persistent or worth
Yes.
trying to fight? You know? At
the core PCE inflation level, it's been above target now for 4 years. And so, is 4 years transitory? Well, most people in a monetary policy sense would agree that that is not transitory. The focus has got to be whether long-term targeting of inflation moves from 2% to 2.5% or 3%. And I think it's one of the reasons why gold has breached the $3,000 an ounce barrier this week and is relentlessly moving to new highs at the moment.
Absolutely. We've talked a little bit in the past about that 2% target, which from what I understand was actually just seemed like a sensible number to target rather than any absolute economic law or rule that meant that 2% was definitely the right number. So if they could start to edge that up around the world, even to 2.5%, it would make a massive difference, wouldn't it?
Yeah. And it's not just the central bankers who are citing trade uncertainty for heightened risk in the economy. We're also starting to see big corporates in the US particularly citing it as being an issue. We're seeing it being mentioned increasingly in RNS announcement on the London market. This week, we've seen both FedEx and Nike say that these uncertainties are causing them problems. And we've also seen Accenture and Delta citing the government cutbacks as reasons for a weaker outlook for their businesses. So this idea that there is some form of Trump put on the equity market has, I think, been tested. And Treasury Secretary Bessent has really underscored this idea that they're much more focused on longer term interest rates than they are about any particular level of the US stock market.
Yeah. Meanwhile, China's doing pretty well.
Well, I wouldn't say it's doing well, but I think it's probably stopped getting worse. We had industrial production data which exceeded expectations for the first 2 months of this year. For now, the equity markets had a very good bounce, but they are going to have to deal with the medium-term impact of a potential protracted trade war with the US. So I think China remains cheap and pretty unloved despite the strong performance year to date. But I think that for the foreseeable future, we may have seen a short-term top in the Chinese market. Close by, meanwhile, Japan has benefited from the increased attention of Warren Buffett, who this week has increased his holding in the portfolio of Japanese trading companies that he's invested in. Elsewhere outside the US, we've seen Germany's Bundestag pass the constitutional change legislation for Chancellor-elect Merz's potential trillion-euro stimulus package, which obviously includes infrastructure and defence spending. So that's continuing to create an opportunity for capital to flow from the US into Europe. The other thing that's hit the headlines this week is the political machinations in Turkey, sparking fears of increased authoritarian rule. The Turkish lira hit a record low against the dollar. So if you're considering where to book your holiday for this summer, if you want to take the risk, Turkey might be an interesting place to go, given that over the last 5 years, the lira versus the dollar has gone from somewhere around 6 to somewhere around 40 at the moment. So, yeah.
Wow. Okay. What about close to home? Much going on in the UK?
We had employment data, which was pretty much as expected, which showed the ongoing unemployment rate in the UK at 4.4%. And this morning we've had continuing government borrowing data, which showing it to be running ahead of expectations, which I think one probably needs to park for the time being, but it doesn't really bode well for next week's spring statement from Rachel Reeves, which I think will be the focal point of this brewing dispute in the Labour government about whether they should continue to look to raise taxes or to reduce government spending. At the moment, the indications are that the cabinet want to reduce spending. So, yeah, I think that's one for next week. But the overriding market sentiment is this one of capital flight from the US to the rest of the world. One of the interesting features this week has also been the Bank of America investor survey that basically records the intentions of the world's largest asset managers, how they're going to be allocating their capital in coming weeks and months. And they recorded the biggest 1 month allocation away from US equities ever recorded. Now, we know some of that has gone to Germany and the wider European market, and some has gone into China as far as equity allocations are concerned. I think there's been a big allocation for the time being into US treasuries, which is possibly not a permanent home for this capital. But although there's no direct evidence of much of this capital finding its way into the UK market, I still remain of the view that this is something that we could hope, if not expect, to see during the course of this year.
Yeah, we should be on the list somewhere, you'd expect.
We live in hope.
Yeah, it should, some of it might start making its way to the lower reaches of AIM would be fantastic. And before we talk about the UK news for the week, you mentioned there are a couple of interesting moves in terms of commodity prices.
Yeah, so the one relentless bull market of the last year to date has been gold. I think it's quite interesting that Treasury Secretary Bessent this week ruled out the option of revaluing the US's gold assets as a way of reducing and refinancing its debt liability. Now, it doesn't seem to have reduced investors' enthusiasm for the yellow metal. But while lots of focus has been on the gold price and increasing number of financial commentators highlighting it as the way to play the tariff uncertainty and the global markets, it actually has not been the best performing metal year to date. Copper is actually up 25% since January the 1st versus gold's meager 15% move. And one of the factors going on here is, again, coming back to this sort of trade uncertainty and tariff uncertainty, is that there's a feeling that copper is being stockpiled by users of this metal to beat the impact of future trade tariffs. Now, there's a lot of volatility in a lot of off-the-run critical metals, many of which are tiny markets that have got very specialist use cases. But in most cases, these are markets that are controlled or certainly strongly dominated by China. So I think there's a lot going on in the background here in metal prices. Clearly, these industrial metals have different cycles than the monetary metals like gold and silver. But there's a lot of price signaling going on here. And yeah, I just suspect in the short term, medium term, gold has probably topped out a bit. So what about in the UK this week? What have you been looking at?
Well, there are a couple of things stood out in terms of one of them a progressive client and one of them a stock that we know through some other work we do with a couple of the brokers. So the first one on Monday was Beeks. They had H1 results, and Beeks is a provider of essentially IT infrastructure for financial trading of various different types. It was H1 numbers. They were pretty strong, revenue up 22%, EBITDA up 25%. They talked about some good client wins. But the market reacted really quite badly to a particular change that they announced with regard to the way they deal with their Exchange Cloud customers. And essentially, Beeks is moving with this part of its business for new customers onto more of a revenue sharing model. So the idea is that it will help reduce the barriers to new customers signing up as there's less of an upfront cost or expense for them. And that should allow Beeks to win more business in the long term. But in the short term, it did lead us, and I think others, to reduce expectations for the FY25 forecasts. And that was really taken quite badly. The shares were off, I think, 15 or 20% on the day. They've recovered about half of that across the rest of the week. But overall, it wasn't a well-received shift from the business, which is a bit of a surprise. But it really does feel like a business which has got some great customers coming through. They've got some fantastic reference sites for all parts of their business. And it feels like they're really generating growth. So hopefully the business will be able to explain that and reassure investors over time that this was the right move for them to have made. The other piece of news this week was from FDM, which is a provider of effectively graduate level IT resource into large enterprise and government customers. And on Wednesday, they announced their full year 2024 results, which are almost exactly in line with their trading update previously. So no surprises in the 24 numbers, but they were starting to talk about some signs of increased activity amongst their customers. They talked about a modest uptick in demand across a number of their geographies. The shares were up, I think, more than 15% on the back of that news. So I think FDM is quite an interesting business because it is genuinely global in terms of its reach. It's got big businesses in the UK, North America, moderate sized in Europe, and also in Asia. So it's quite a good barometer of these things in terms of corporate demand or project starts within large corporates around the IT and regulatory and compliance areas in a number of cases. So there are definitely some signs of improved activity there. The shares are up quite strongly. One other thing which they did was that they announced a dividend which is higher than it would have been under their official dividend policy. And they saw that very much as a signal to investors of their confidence. So price discovery isn't perfect, but companies are resorting to any signaling mechanism they can. And I think dividend is an important part of that signaling methodology. So yeah, that was, again, well received. So yeah, lots going on. And what about next week? What's coming up macro-wise?
We have UK inflation data on Wednesday, where the consensus is for a year-on-year rate for February to be at around 2.7% versus the previous 3%. But I think the main economic data next week is going to be around US Q4 GDP data, which will show a slowing of growth from over 3% to something closer to 2% year on year. Now, bear in mind the Atlanta Fed GDP now estimate is that for Q1 2025, US GDP is tracking somewhere around -2%. So this is a huge shift that some people are explaining as being influenced by short-term moves in stockpiling around tariff measures or the fear of tariff measures. So maybe we can get a one-quarter rogue figure, if you like, before we can sort of reestablish a stronger GDP trend in the US. But this is something that I think will be a debating point for some weeks to come. And on top of that, on Friday, we get US PCE data, which is the preferred measure of inflation for the Federal Reserve, for the FOMC. And that is expected to be running up at 2.8% from 2.6% in January. So right now, this pincer movement between growth and inflation is continuing. And I think this data combined is not going to allow us to sort of move away from this underlying fear of stagflation emerging in the US, but more broadly around the world. So yeah, not great. Obviously, we've also got political manoeuvrings underway as well, not least of which in the UK is going to be around the spring statement and the debates around that as well.
So risk of the word stagflation rearing its head in the States and domestic disagreement in the Labour Party. So we'll find out next Friday. Great. Thanks very much, Jeremy. Good to talk to you, and we'll speak next week.
See you then.
Talk to you then.
Brought to you by Progressive Equity.